If you look at big events where governments have had huge effects on people, it's through fiscal policy. Fiscal policy has huge ability to affect an economy. The central bank's a sideshow. This isn't what you hear in the news, but to a first approximation, it's a place to start. And the government has the authority to tax you. It can enforce it. They take money, and now what do they do with it? It could buy goods that all of us have to consume. There's goods like this tie. This is a private good. Only I consume it. You get to observe how beautiful it is. Okay, my wife gets to see that, yeah, he did wear a tie. I told him to wear a tie. But it's a private good. The military, police, fire. Now, all those things thought to be public things. So the government spends money on those things. If you're like the United States now, we spend more than we tax. So what do is we borrow from our own. We issue bonds. When the government spends more than it takes in, it issues debt. What the monetary authority does, in pure theory, is, well, it can print money. What can it do with the money? It can't go out and spend it. What it can do is go buy those government bonds. Its assets are government bonds, and its liabilities are money. One of the most important papers of economics in the 20th century was written by someone who thought monetary policy was very important. It was Milton Friedman. And he said, I'm basically a guy who thinks it's really powerful, and I'm going to tell you why it's not powerful. And he tells you the only thing the central bank can do is it can affect the price level, but it can have only temporary effects on interest rates. Interest rates are largely determined elsewhere. Alan Greenspan was a master. Congress would ask him about monetary policy, and he said, basically, if you don't run big deficits, if you balance the budget, my job's easy.